The macroeconomic climate is constantly evolving, and uncertainty is part of the current economic equation. Pricing corrections are taking place in both public and private markets, and in both late stage and early stage companies. While this is a hard time for many in the startup ecosystem, historically, downturns have actually proven to be an excellent time to invest into private companies. Let's dive in and explore this together. It may be instructive to examine a traditional VC fund's portfolio dynamics. Once a VC fund has raised, say, $100 million, it usually deploys that capital over the course of 3 to 5 years and across 20 to 30 investments. Timing is everything for a VC fund. An economic downturn can either destroy a fund or absolutely make a fund. So here are 3 scenarios to consider. The first one we call predeployment. This is where the fund has been mostly deployed and then the downturn hits. This is the worst case scenario for the fund because their portfolio of 20 to 30 companies will likely be devastated, which results in a much higher failure rate. The second example we call bridged deployment. This is where the fund has been partially deployed before the downturn, some during the downturn, and then some after. The fund returns will likely have a muted effect because a portion of the portfolio will have a higher failure rate. The third and last is called post-deployment. This is the best case scenario. As they say, you can't buy timing. In this case, the VC raised its fund just before the downturn. This allows them to deploy the entire fund both during and after the downturn, which will yield the best outcome for the portfolio. There are well-documented success stories of both VC funds and startups that emerged from the 2001 dot-com bust and the 2008 financial crisis. Recent companies include WhatsApp, Venmo, Uber, Airbnb, Pinterest, Instagram, Slack, and Square, amongst many, many others. We believe Sweater is positioned perfectly to take advantage of the current macroeconomic market fluctuations. We cannot overemphasize, you cannot buy timing. And we are incredibly grateful for the moment that the Cashmere Fund is entering the market. In addition to good timing, Sweater is also investing into hundreds of companies over the next few years, not just dozens. This diversifies risk exposure even more than a traditional VC fund. And those benefits are returned back to our members. Market volatility must be managed and mitigated, even when deploying capital with good timing. Sweater takes the responsibility and stewardship over our members' capital very seriously. And we are excited at how we can help shape the future starting during this moment in time.